2024 has been a bit challenging for Hong Kong retail, despite having northbound travel, also sales leakage to other competitive markets and a strong Hong Kong dollar, and also some changing spending patterns of locals and tourists that is not helping the Hong Kong economy and the Hong Kong retail market. But despite all of that, we do see that in the second half of last year, there are signs of stabilizing. If we look at our own results, although for the full year the revenue dropped by around 2.2%, actually most of the drop came from the first half, which is around negative 4%. But in the second half, it's sort of stabilized. And revenue half on half has actually improved by around 0.3%. And in terms of occupancy, because of our completion of our largest asset enhancement project at Plus Wu, we have actually managed to pick up the occupancy from 94.1% end of 2023 to now around 95%. So we do see that starting from the second half of last year with all the supportive measures from the government, including expansion of the individual visit schemes and also the resumption of the multi-visit scheme for Shenzhen residents. And if we will be expanding this multiple entry permits to other GBA cities, I think that would further boost the retail market in Hong Kong in 2025.
So we're seeing encouraging signs of the Hong Kong Tourism Bureau saying that tourism is surging in Hong Kong. 70%, of course, of the tourists coming to Hong Kong are from the mainland, but ASEAN has been very active coming to the city here. I want to ask you about the retail space because retail sales fell 7.3% last year. Give us an indication of the health of the retail industry and the stability that this is on your tenants.
Sure. Because Fortune Reit actually manages 60 neighborhood malls in Hong Kong, so we're more dependent on local spending and also non-discretionary spending. If we look at the retail sales figures from the overall retail sales figures from last year, actually, if we look at cosmetics and some of the more durable kind of trades, I think that the fall is actually less than some of the more consumable trades. So for our type of malls, I think overall it has been more resilient than probably the broader market. And then looking into the January retail sales figure, I think the decline has actually narrowed to around 3%. So although part of that would be the CNY effect, but other than that, we're also seeing that supermarkets, cosmetics continue to be positive in the January sales figures. So that actually provides some positive signs to the retail market in general.
I want to get your take on some of the macro impact as well. Of course, Trump, geopolitics, the tariffs, high on, we talk about it regularly here on the channel, of course, as we wait to hear from him speaking in Congress a little bit later this morning as well. Has there been any impact from the uncertainty that the tariffs bring to Hong Kong's economy and the impact on your business?
Sure, because our business is actually more local. I think the performance of the broader economy actually has an impact on how people or how the locals spend in Hong Kong. So overall, I think we remain quite cautious going into 2025. But having said that, I think given the volatility in the market, REIT would be quite a defensive product that I think investors can consider. And for our own capital management side, given all the volatility, we have been trying to be more prudent. We kept our interest rate hedging at over 50%. Now it's around 55% to mitigate some of the interest rate volatility that may come along the way. And also, we are also in early discussions about our refinancing, which is due at the end of the year. We're actually starting that much sooner than usual in order to be able to make sure we have a good capital management structure and a good balance sheet going forward.